This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Welcome to episode 5 of Value Investing. In this episode, I'm going to talk about very interesting topics. I'm going to talk about two topics that were in Warren Buffett's early investment partnership letter. First topic is going to be about why so many institutional investors do not perform as well as the market. This is quite fascinating topic given that we are talking about exactly the same subject in today's investment environment. We are asking questions such as why hedge fund managers are not performing as well as the market or private equity managers in the same regard. And it's quite interesting because we can see Warren Buffett's point of views that he laid out many decades earlier. So you're going to find very useful insights from there. And second topic that I'm going to talk about is the diversification in your portfolio. And a lot of people focus on how important it is to diversify your portfolio across different stocks and across different industry. And Warren Buffett provides in his letter his views on diversification, why it makes sense for him to own small number of stocks instead of having many stocks in his portfolio in order to have good outstanding performance. So it's going to be a very interesting topic. So why don't we get started right now? Let's talk about why so many institutional investors do not perform as well as the market, which is the average. Institutional investors usually graduated from top schools. They have high IQs and they're bright and energetic, so they have all the components necessary to be successful. And virtually all these institutional firms have unlimited resources, whether it's money or people. And they also have most extensive business contacts across the industry and have centuries of aggregate investment experience. Now, given all that, it makes sense for these institutional firms to perform better than the market because market is the average. But that hasn't been the case historically, and we have to ask questions why that's the case. Warren Buffett asked these questions in his investment letter, and he laid out 4 different reasons why he thinks that these institutional investors do not perform well. But what's quite interesting is that he was running his investment partnership and he was asking these questions. It's not really in his best interest to talk about these topics, but he brings these problems onto the surface and discuss openly with his investment partners. First reason that he said in the letter why these institutional investors do not perform well is because they make decisions based on consensus in many cases. A lot of these large firms have something called investment committee. They come together to make a bunch of investment decisions and they do it based on consensus. But the problem with the consensus is that if you're making decisions based on everyone's agreement, then it's not likely that you're going to make controversial investment decision. That's where a lot of money lies. A lot of great investors have previously made very controversial decisions where nobody wanted to touch such stocks. And they go against the crowd and they make contrary investment decision and they make tons of money if the crowd turns out to be wrong. And that cannot happen when you are making the decisions based on consensus. Second, Buffett also mentioned that these institutional investors have a strong desire to conform to the policies and portfolios of other large, well-regarded organizations. So what they do every quarter or every year is that they try to review the holdings of their competitors. If they feel that they're behind of their competitors, they can easily jump on the bandwagon and try to ride their competitors' coattails in terms of investment success. One example that I can give to you is that when Bill Ackman from Pershing Square made tons of money for his clients, a lot of other hedge fund managers just follow suit without doing their homework. So at the beginning, they made a lot of money. For example, Valiant pharmaceutical company. But if you just implement these strategies without your logic and without doing your homework, then you don't know when these star managers first sell their stocks. And also, it's possible that these star managers made a mistake. In this case, Valiant. So Valiant stock went down more than 90%. And these investors who just follow suit lost tons of money in this strategy. I think one advice that I can glean from here is that you have to have a logic and rationale while you're buying such investment. Third thing that Buffett mentioned is that these institutional investors have a framework whereby average is safe. These institutional investors have a personal and career risk. It's important for them to make good investments, but if they make controversial investment decisions, if something goes wrong, their neck is on the line. If these investors buy Amazon, Google, and if these stocks go down, then investors will ask, what's wrong with Amazon? What's wrong with Google? If these institutional investors buy a company that nobody has ever heard of, and if that stock goes down, then they're going to ask, what's wrong with you? So there is a personal and career risk that are playing here. These institutional investors are trying to avoid controversial stocks. Fourth, sometimes these institutional firms adhere to certain diversification practices that do not make sense. Warren Buffett didn't really explain what it is, but I think that one example that I can think of here is that let's say you have 10 stocks in your portfolio and you have 2 really big winners that have gone up in price by 200%, and you have one loser that has gone down by 80%. If you're trying to sell these 2 winners and buy the loser in your portfolio, or sell loser and buy winners in your portfolio, whatever your rebalancing strategy is, I think that it is a mistake. If you just do that for the purpose of rebalancing, it's a mistake. But you always have to base your decisions on the intrinsic value you assess in the company and compare that against the market value. You always have to look at the attractiveness each security individually and see how you can assess the probability in the future, not based on percentage of composition in your overall portfolio. So these are the 4 points that Warren Buffett mentioned as to why a majority of institutional investors do not perform as well as the market. If you were one of these institutional investors, I think it's important for you to review your process, and if any of these characteristics applies to you, then think about changing your process so that you can become more competitive in the market. One last point that I want to bring up here before we close on this topic is that a lot of these institutional managers charge very high fees to their clients. And Warren Buffett has criticized these institutional investors over the last many decades, but he didn't really mention these points in his initial early investment letter. So that's why I wanted to bring it up here. And I assume that at that time, Warren Buffett charged high fees. I discussed about the fee structure of limited investment partnership in one of my episodes earlier. But he was able to produce really great outstanding returns to his limited partners. I think it's okay to charge high fees to your clients if you are making good returns. So it's just same as any other industries where you buy a certain product. If it's a high quality product, you pay higher price. And if you get better services, you pay higher price. So that's kind of very common across other industries. When it comes to the investment community and investment firms, I think it's important to know which company is providing the high quality services and products, because if investment firms do not provide higher return, then it's really difficult for them to justify the fees that they are charging to their clients. And the common standard fees they charge these days, including hedge fund managers and private equity managers, is 2% on total asset under management for their ongoing management process, and also 20% on the profit they generate. On the other hand, a lot of ETF index funds are charging enormously small amount of fees to their customers. For example, if you look at Vanguard S&P 500 index fund, they're charging less than 8 basis points of your total asset. So that's significantly small compared to the fees that a lot of these institutional investors are charging. So if you're an institutional investor, then you have to keep in mind that you have the obligation to communicate clearly, just as Warren Buffett did in his letter, how much value you're creating for your clients, and what is your value compared against these other competitors like Vanguard, who has very low cost index funds. And that's why these days the hedge fund industry is struggling quite a bit, because they were not able to convince their investors and their clients of their existence. So why don't we switch gears to the next topic, which is going to be about diversification. Warren Buffett laid out his views on diversification in one of his investment letters. And he said that he's willing to invest up to 40% of his net worth in a single company if the right opportunity arises. So if you think about it, this is quite different from other investment funds strategies at that time. And even in today's environment, if you go to any hedge funds, I think it's going to be very rare to find any hedge fund who's willing to spend up to this portion of their net worth in a single company. Warren Buffett said that this 40% investment opportunity is going to be very rare, and once it arises, then the probability of the potential success is very high, and the probability of the risk of losing the capital permanently is going to be very small. But I also want to note that Warren Buffett is not against the concept of diversification. He said, quote, "There's nothing I would like better than to have 50 different investment opportunities, all of which have a mathematical expectation of achieving performance surpassing Dow by 15% points." But he said that it doesn't work that way. So if you are managing your portfolio, you like to have this kind of opportunities all over the place, but that's not just the way it is. You should not really think of investment from mathematical perspective in that regard, because you're not going to find really great investment opportunities in 50 different stocks that you're looking at. Warren Buffett said he has to work really extremely hard just to find a few attractive investment situations which have the performance expectations of exceeding the Dow by 10% points. Among the ones that he found, the next question that Warren Buffett said he has to ask to himself is, how much do I put in number 1 security versus number 8 security? And he said it depends on the situation, but you have to think about the probability of the success in the investment success in the future, and also you have to think about the probability of the risk of these investment securities. So Warren Buffett gave one example. So let's say we have 2 securities with equal mathematical expectations, and one has 5% chance of going down by more than 15% than the market, and the other one only has 1% chance of having such situation. So if we have these 2 securities with the same probability of success in the future, then he would prefer to invest in the first security. That's kind of obvious. and he's not going to concentrate his bet on the second security. Everything that he said so far sounds very precise, but as I mentioned, it's not really working that way when you're managing your portfolio. And he also mentioned that if you want good performance, any portfolio with 500 stocks and more are not logical. Because if you want to beat the market, then that's not the way you're managing your portfolio. And 100th stock has no diversification benefit whatsoever, but has negative effect on your portfolio. Think about it. I've read some article before about how many stocks are enough to have good diversification benefits. I think you can search Google about diversification benefit and number of stocks. And the marginal benefit that you're getting from adding one stock to your portfolio is going to be very high if you only have one single stock in your portfolio. But as you add more and more stocks to your portfolio, the marginal benefit that you're going to get by adding one more stock to your portfolio is going to diminish. The article says that the benefit is going to increase up to 10 to 15 stocks, but beyond that point, the benefit is going to be flattened out. You're not going to get much benefit. Whereas you have to also think about the cost associated with diversification, because you cannot really maintain 100 stocks in your portfolio. You're not going to be able to understand all these different companies. Your time is limited and your resources are limited, so you have to think about the cost associated with doing the research on these stocks. As far as the number of stocks is concerned in your portfolio, it might be true that you have all the diversification you need if you just have one stock called Berkshire Hathaway. Think about it. So under one roof, Berkshire Hathaway has multiple businesses across different industries. If you buy one Berkshire Hathaway stock, then you might be good enough in your diversification benefit and strategy. One last point that I want to touch upon in terms of diversification is that Warren Buffett says in the letter that he's willing to concentrate quite heavily in small number of stocks and suffer from short-term volatility in the market, if that means potentially high probability of success in the long term. What a lot of people are mentioning when they say diversification benefit is that the portfolio volatility, return volatility, is going to be reduced quite significantly if you buy different stocks in different industries. But Warren Buffett doesn't really care about this short-term volatility, ups and downs in your portfolio returns over the next week or over the next month or over the next year. What he cares about is a long-term profit. So he has different objectives. I think that gives him advantages over other institutional investors because his time period, investment time period, is over the course of 5 years, and he doesn't care about the volatilities within 1 year time period, and he's willing to take that risk if that means that he's going to produce better return over long term. So diversification can come into play here because if you have 100 stocks, then your portfolio is going to fluctuate similar to the general market, and your return is going to be similar to the general market. But if you have 5 stocks in your portfolio, the volatility is going to be very high compared to the market. That's how people measure the risks of individual stocks, but that's not the way how Warren Buffett measures risks in his portfolio, and he's willing to take that risk. In one of the subsequent episodes, I think I'll have the opportunity to talk about how Warren Buffett defines investment risk in portfolio and in a single stock. So the way he defines the risk is quite different from what academia defines the risk, investment risk, in their mathematical models. So I think it's going to be quite fascinating topic. But I think that today we talk enough about diversification and how it's linked to the investment risk that Warren Buffett tried to explain. So I hope that you learn quite a lot from this episode. Okay, that's it for this episode. If you haven't already done so, please subscribe to my channel wherever you listen to this podcast. In the subsequent episodes, I'll continue to talk about Warren Buffett, and there will be a lot of interesting topics. So I'm so excited, and see you next time.